Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Welcome to this episode of the Australian Investors Podcast.
It's good to be here.
It is. We are joined by the Master in Chief, the great man, Jamie Nemtsas. Welcome, mate.
Thank you.
There's a applause from the crowd. It's raging. Mate, welcome. We've been hanging for this for a long time, and so we really appreciate it.
Yeah, no problem. I'm not sure your listeners have been hanging for it, but you two have been in my ear for the last few months. So
yeah,
glad to be here.
Well, we're going to answer some questions today. You come on the right show. We're going to answer some questions. We're also going to put some hypotheticals to you because we've been putting them to each other and we really don't know what we're doing. So hopefully you can bring some insights to it.
Sure.
Where do you want to start, Drew?
I mean, there's some massive earnings results this week. Do we start straight in the earnings results, or do we?
Go for it.
I could pose a question to both of you, though. That was probably the most interesting one.
Okay, go.
Right in the daily update, the Dow Jones is on its biggest winning streak.
Sure.
Got to 13 days in a row of positive closes. When was the last time it had a winning streak this long?
I'll go 2017.
I'll go 2009.
1987.
Oh, wow. Okay. Was there a reason for that, or was it just like one of those days?
I think it's just one of those days. Was that post the recession, pre-tech bubble?
Wow.
But 13 days in a row for the Dow Jones. 87.
Before the biggest stock market
crash in history, yeah. Slightly before.
Did you say post-recession? Or? Jeez, way to just bring it down around recession. Okay.
That's incredible, isn't it? That's 30 years ago, 30 plus years ago. So the Dow hasn't had it since. So,
which is crazy. And there's a reason why, and you've seen two massive earnings results overnight.
Yeah.
Did you keep a close eye on Microsoft?
I was actually, yes, not Microsoft, Alphabet more so.
Yeah.
But
more relevant to your business.
Yeah. Actually, that's a good inside hack if you just listen to the Alphabet calls and you just tune in for the search moment. If you're a business that operates online, you hear what they're working on. So they say, we're going to focus on YouTube. So what do? If you've got an online business, you just go to YouTube and you do exactly what they're trying to prioritize. That's how you game the algorithm.
I think he's just going away.
Yeah, there goes the secret. No, but good results. The big tech is just smashing it at the moment, and we're going to talk about that in a minute because we do have a higher or lower for old mate.
We do.
Yeah. Summary.
Is that how I'm referred, old mate?
Yeah.
Thanks.
He's not. You're only a couple of years older than me,
sure.
so we're post-franking
and I look
credits.
older than both
Owen is pre-franking credits. That's how we differentiate. 1985. That's all that matters.
No, Drew. Good results. Very strong results. We've got a comment that you said before, Jamie, about the tail end of the NASDAQ not being as strong as people maybe realise.
Sure.
Yeah. So we'll talk to that when we get to the question. But any of these cloud businesses, I think it's fair to say, are just eating the cooking of everyone else. They're taking share of traditional IT services businesses. When Amazon was early days with the cloud business, they estimated it was a $1 trillion a year opportunity.
And it's still tiny. Like the adoption is still tiny. Maybe in large businesses, most of them have gone to the cloud, but a lot of small businesses still like flirting or barely on the cloud.
Yeah, absolutely. So, and Microsoft is the beast, if you think about it, because it's got Azure with the cloud, but then it's also got like the suite of Office products. It basically owns business. And then it's also got the gaming and the AI side, which is obviously what's driving a lot of people at the moment and investors.
It definitely, ChatGPT, the OpenAI, I know that's open on your desk for large chunks of the day. They actually mentioned that in the earnings update, which talked about the fact that they're not pricing in much of an uptick in earnings or revenue from AI at any time in the next 2 to 3 years.
Yeah.
So analysts like the idea that any impact could be a massive jump in what they've predicted so far.
Yeah.
It's not surprising though if you start thinking about. I've got a year 10 boy, and he's studying business, and he has to present a business idea, and you go, what's a good business, Dad? And you start thinking about what we heard around tech in the last 5 years. Make sure that everyone in the world is a potential client. Make sure it's scalable without capital. Make sure, all these elements that you need to use it in your daily life. And everyone was saying that, every tech company.
Got an idea for an app.
That's right.
Yeah.
I got an idea. But the very big tech, they own that space. Like everyone is using Microsoft. Everyone uses Google. Everyone has a Facebook site. So we talk about the fallout around tech, but it's not surprising. You have the haves and the have-nots.
Yeah.
Microsoft and Google obviously haves. So
Yeah. Like the railroads of this century, right?
sure.
You constantly question that they're constantly questioned how big they are within the benchmark, and then how can they possibly stay there? But then they continue to find verticals that keep them there.
We saw 2 weeks ago, remember the NASDAQ readjusted?
Yeah,
Yeah, and
they had to cut the
they cut the
exposure.
weightings because, and it's only happened twice in history. I think we were saying at the time.
Yeah.
They actually had to. Well, they didn't have to, but they chose to reduce the exposure to the tech stocks. And this is from the NASDAQ. Artificially.
So it's not on market cap anymore.
Yeah, it's like a market cap minus type benchmark.
Does that count as active management?
As active.
Yeah,
Sure.
yeah. Everyone that's just got the
Active
NASDAQ
overlay.
ETF have sold it. So, sorry, I only do index funds.
Shows you that, but we worry about the ASX being 45% two sectors. It's no different overseas.
Yeah.
So it's always the challenge that we talk about when you're building portfolios with passive only investments, that you do get these weightings to individual companies. So why it's important to blend.
Here's a question for you. A year from now, so YouTube ad sales, 7.7 billion, right? YouTube at 7.7 billion. In a year from now, will it be higher or will it be lower?
Well, you're going to use them and Jamie's going to use them, so I suggest it be higher.
Sure. I'll go higher for sure.
Yeah, I'd say higher. But it has been slowing. The growth rate has been slowing dramatically. It was a bit of a rebound this quarter, but over the last couple of years, it's been slowing since COVID. So
They're a bit of a canary for ad spend.
yeah,
Generally, though, aren't they? So if companies are reining their belts in, you're generally going to see.
I mean, we're going to talk about NVIDIA a little bit later, but you forget how these really big tech companies are hard to value because their ability to reinvent themselves is nearly instantaneous. So as soon as you go, Facebook isn't relevant anymore, why would you have Facebook? They come out with Facebook Shorts or whatever is the new product.
Yeah.
And they've got teams working on where it's going, what's the innovation. They've got the massive amounts of capital to go, well, that company's interesting. It's now $4 billion market cap, but we think it's going there, so we'll buy them.
Yeah. Well, Facebook came out with the Threads thing recently.
Threads.
Yeah.
Is it data already?
Huh?
Is it data already?
Yeah,
Someone said
probably
it
has.
data already.
Yeah. Elon then changed it from Twitter to X, just to make it different. But yeah, that's true, right? And
YouTube was bought, wasn't it?
but it was acquired. Yeah. And I mean, so many of those businesses. Look at Microsoft; it's buying Activision Blizzard.
Yep.
Right. So LinkedIn.
Yep.
Who would have thought that you could do LinkedIn? I remember reading the original statement from Microsoft on this, and they said they're going to connect LinkedIn the same way you connect with emails. So you could, instead of sending an email, you could just click on their profile in your Outlook, and you could go send an email to that person there. I don't think they've done that yet, as far as I know, but that's they're eating the world basically, and it's pretty cool. It's pretty cool to see as someone who invests in these types of businesses. Real quick, I think maybe that round of applause should actually apply now, Andrew Deremith. Because
Who's that for?
this is Andrew Deremith's moment in the sun, because inflation caught the world by storm. Lower than
It's been
expected.
lonely out here in the contrarian position for quite a
It's been lonely being right.
I've got 3 months left. I think they're cutting the number of meetings. Is that starting this year or next year? That doesn't help me with my rate
next year,
cut call. It's definitely, it's definitely going to be next year. I've already backpedaled for the last 6 weeks.
Okay.
But we had inflation.
So you don't reckon there's any chance of a rate cut this year?
And there's always a chance, but property prices just went up too, which makes it hard to cut rates right now.
Interesting.
I think you need this one. Oh, no, wrong one. But yeah, so my call has been it would be a rate cut, but then the Federal Reserve just increased again last week, and that's basically this idea that the impact of interest rates has barely been felt across most of the economy itself yet, and at some point it will hit. And I've been
especially in the US, right? So they have to raise rates higher than they are in Australia because they don't have such an impact in the US as most people are on fixed 30-year loans.
Yeah, we're hitting in the pocket straight away.
Imagine that. Imagine if 2 years ago they offered 30-year loans here in Australia.
Fixed.
Fixed.
We can only get up to 5 years fixed.
Wow.
Yeah, but the percentage that they sell 5 years fixed is quite minimal.
Yeah.
They used to have 7 and 9, but no one would buy 7 and 9. So
Oh, right. Okay.
It fell from 7 to 6, but Jamie was saying off air that I think the quarterly rate was 0.8. So
because I'm forward looking,
not backward.
if you times 0.8 by 4, obviously you get 3.2.
We've got a name for this annualisation too, don't we? We're going to let them
There's been a lot of annualisations over the last 6 months, but not so much in inflation. It's been more about property prices, which definitely hasn't worked from the fear mongering. Yeah, it's pretty good though, right, Jamie?
So it releases a lot of pressure that we're seeing.
Yeah.
And then you automatically start thinking about interest rates, what potentially. So if Drew is right and they're going to cut sometime next year, then you'll start seeing that in longer term rates. And from an investor's point of view, you see that in term deposit rates. So you've seen some really good 5-year term deposit rates. You'll start seeing the rate on offer disappear relatively soon, even though that rates mightn't fall until sometime next year.
Yeah. Yeah. And then in terms of, Drew actually mentioned something not too long ago, Jamie, talking about floating rates being
like preference shares,
all those types of things. Recently, floating rates being something that folks were flocking to, like some advisors and some groups were talking a lot about. How do you think about that in client portfolios at Waddle right now? Do you think
probably around the flows as well, that a lot of money was going into them?
I think it's really important for the audience to know that Drew and I share an office.
So if I say it on here, Jamie's heard it 4 times already.
Yeah. Or it was originally my idea, and then I hear it on a Saturday morning. Well done, Drew.
I say, what's the word? Copying is the best form of flattery.
Yeah, it's flattering.
That's right.
All content.
Jamie doesn't even have to appear on the podcast. His insights are shared.
But something Drew and I talk about is the flow of money, and everyone follows the flow of money. And we know that bonds were poor last year, so everyone's going, we're not going to hold bonds anymore. We're going to hold something else, and floating rate notes, whatever vehicle they are. So if they are corporate or real estate, or if they're credit, then have been really, really popular because their historical return looks good. So suddenly bonds, historical return looks poor, the floating rates look good, so you get money being pushed into that sector. And we see that in every asset class, really. Money follows good returns, but that doesn't necessarily build better portfolios. So what would you buy in the future? If you do think rates are going down, the way that you make money out of rates going down is hold long bonds. So the worst performing asset class of last year, you're probably buying more of it at the moment.
Yeah.
Another idea I saw from Jamie was
go for it.
Well, where everyone talks about this being unprecedented and interest rates rising so quickly and this unparalleled volatile environment, but we keep reminding people that this is normal. Like interest rates at 3.5%, 4% are normal. You should get money you should get paid for putting money in the bank.
Yeah.
Like 0% was abnormal.
Yeah, absolutely.
So this is a normalised environment now, not an abnormal environment.
And you have to build portfolios appropriately for that environment.
So then, in your opinion, we are closer to a normalised environment right now than we were 2 years ago?
Very much, yeah. There's still a lag on the actual economy, clearly. We don't know the impact of all those interest rate hikes yet, but normal interest rate policy.
Yeah. I'll tell you something that I'm very joyful about when I see joy in the streets. Something that I'm very happy with is house prices up as a homeowner. I mean, it's not great if you're trying to buy a house. Yeah, but that property Armageddon is probably not around because it looks like in the data here, Sydney house prices up 5.3% in June. That's off a big That's off a big base as well. 2.7% in Australia. Melbourne, Melbourne I think was the worst from memory. So that's all right.
But well below the average.
Yeah. But the Australian property is probably not what they expected, some of them. At least not what they chose to write at some of the outlets, which shall remain nameless.
It's still only 10-12% off the high, isn't it? Like that we got into late 2020, 2021.
I think it's high single digits from memory. So,
but it is an asset class that is very hard to see its valuation. So if you think a typical property gets sold every 15 years or something, so
getting short of that as well, yeah.
And then between them, you can't necessarily determine the value, and there will only be one or two buyers. It's not necessarily an efficient market. So if you have a Saturday and everyone's pumped up and there's 4 buyers, potentially you could get, 20% over what you could in a rainy Saturday. So it's hard to determine valuations.
Yeah, I agree. The underlying indices are pretty crooked, right? They're pretty shaky, but
that's the challenge of policy making, though, isn't it? Because you have to use that data.
Oh, yeah, they get the same stuff that we get, probably worse sometimes, right?
Yeah, probably worse.
Yeah, like what are they going on? ABS data, and it's updated every how often?
Yep.
At least like the sales data, and that can be weekly or even monthly. Anything else, Drew? News of the week? News of the world?
I mean, you can stick with this inflation story, which was, and the impact of interest rates on the economy, where we had Kogan report this week. Share price went up 8-10%, but sales fell 22%. So Kogan being the discount electronics retailer, they had a massive issue a few years ago. I think we talked about, which was they over-invested in inventory and had a massive overstocking. Had to cut prices on everything. But you're seeing some pain come into retailers at different parts of the economy at different points, and you're seeing the slow impact of interest rate hikes coming through.
They definitely overcapitalised, and I bought one of those TVs, and I got to tell you, it's not good.
They're not great. I bought a whole stereo system and just put it out for hard rubbish. Like ship it out the front. That's some. We can't be too negative.
Yeah, just
someone.
But it's going straight down the man cave. That TV.
If it
it's
ever
not
arrives.
good enough. It doesn't even turn on really. So Kogan will now send us some
Free
updated
TVs.
versions. Other news. We've got plenty of news.
We'll be filming remotely next week.
Yes.
Jamie and I are off to a big investment conference.
Yeah, is it sold out? New Zealand?
Yep, sold out in New Zealand. So in Queenstown,
Yep.
2.5 days with a whole heap of institutional wealth management people talking about portfolio construction, top down.
Yeah, cool.
You just did the run through highlights of the sessions there.
Yeah, should be pretty good.
Yeah.
Lots of different people providing different opinions. So good to get with peers that do the same role that Drew and I do every day and talk about how you position portfolios and what they're using. New Zealand Super's there, so the head of asset allocation from New Zealand Super is coming along. So
is there a lot of it NZ-based advisors as well?
I mean, the advice industry in New Zealand is growing ever since Kiwi Saver was introduced about 6 or 7 years ago, probably now. So there's 2 levels of advisors over there. There's the insurance and mortgage broker, and then there's kind of this investment advisor. So there's a lot less like us over there.
Yep.
But some really good firms. They have the same types of issues, right? They're essentially an island in the middle of the sea, and what do they do with currency, and how do they get exposure, and how do they invest in really good companies, and bias to their own economy is big. So there's lots of learnings we can kind of take away from New Zealand and build relationships with our colleagues over there. So.
I think this NZ Super session might be relevant for this audience too. Like the way they manage money, if you've seen that.
No.
That they operate with what they call reference portfolio, where like 60 to 70% of their assets are benchmarked to index. Then they use their fee budget, which is something we talk about a lot, to find non-correlated or more diversified sources of return.
So that's like basically the core is passive.
Yeah,
exactly. So they're not paying much for the core.
Betas for free.
Betas for free, yeah.
Another good one that Drew came up with.
Then 30%. There might be a court case after this.
Check your contract. All IP is IP, model partners.
So you compare that. So their alt sleeve, which is 30%, would be very much how the future fund invests, right? Yeah. So future fund doesn't have the core passive; they just essentially invest in alts for an outcome.
Yeah, venture capital, private equity, super interesting. And then Andrew Clifford from Platinum is joining us as well.
Yeah.
Oh wow! So that's a pretty big event then. Is it the first? That's the first Inside Network event in New Zealand.
Best one offshore, yeah.
Yeah.
Tasmania. I count that as being offshore, but
I'm sure
That was
you
good.
have Tasmanian
Drew got
listeners,
recognised down, does it?
Yeah, he did.
he did.
we bring that up all the time.
Yeah, the fan.
Okay, well, we're probably a few minutes in. We're 22 minutes in, Christ, and we haven't even got to questions. Anything else before we move to questions, guys?
I saw that UniSuper bought a big property portfolio this week.
Oh,
So,
really?
you're thinking about property, and there's lots going on in the commercial and office space where some big property funds are being squeezed on liquidity. They're getting redemptions. Of course, any fund that offers liquidity but have fixed assets underneath have got issues. So there's a few assets that are being sold, kind of fire sold. And so the value, there's question marks around valuations of industry and office commercial property, but UniSuper, which is essentially the team that was Colonial First State, the investment team, they've always been really good at picking bottoms and being quite aggressive with their approach. So they topped up their real estate exposure, I think, by 1.1 billion this week. So I thought that was quite a interesting sign.
Well, we've seen the listed products and the kind of the unlisted really struggle over the past 12 months, obviously, even since COVID, to be honest. And for someone to come in like that maybe doesn't have the same liquidity requirements right now, that's a big deal.
Yeah.
And so the old blood on the streets story, not saying is a lot of blood yet, but and we talked about it last week, the Invesco, the credit opportunities, where essentially you want to be deploying capital in this market rather than being a seller. You want to be a buyer and you want to have cash ready. I think it's super interesting. It's across multiple sectors as well.
Yeah. Okay, I got a question for you. Is property an alternative investment class, like unlisted property?
Yes.
I would call it real assets, but
Real assets.
and then if you apply, we probably have because we're not saying we.
I'll just take it too.
I have a view. Opportunistic assets are very similar to value assets, and most people are trained to be a value investor.
Yeah.
So as soon as you put opportunistic in front of it, it feels better. So if you would see, which I think are going to be really interesting, opportunistic property funds in the next 18 months, and that's definitely an alternative asset. So there's a lot of money to be made in alternative kind of opportunistic property. There's a big global fund manager we used to invest in. We don't have any money in at the moment, called Walton Street, and
I've heard of them.
Yeah, they do opportunistic property. So,
so when would you invest it? So obviously this market environment is when it sounds interesting, but is that something that you'd hold through the cycle or not really?
So there's a thing called, what's the word?
Vintages.
Vintages. Do you know what vintages are?
You stole that from me. That's good.
Yeah.
See, I do give some ideas back.
Broadly familiar with it. But,
So when you,
but for
essentially it's nearly like dollar cost averaging, but into private markets. So if you're going to invest in PE, is probably the easiest. You don't just want to buy this year's vintage. You want to buy an average of the next 5 years' vintages, because you'll be a very good vintage within that 5 years, and it's very hard to assess which year. So allocating to, if you are a stock picker, which I think most of us think we are, then you try to pick the vintages, right? So the vintage in distressed assets happened to be 2008, 2009, when everything was distressed. At the moment, looks like there's lots of good opportunities around. So if you're a stock picker, buy this year. Yeah. If you're a prudent long-term investor, buy a little bit over the next 5 years.
Yeah, if you commit the asset class, then you want to keep allocating to it, and you'll get liquidity from that over time too.
Yeah. Yeah,
but that's what you want at the moment, is you want to be a liquidity provider to people who are being forced to sell for one reason or another.
And if all ends of the risk spectrum are going to feel that, I reckon.
Even that,
you've seen in equities.
You could argue that in small cap, Aussie small caps, right?
Exactly.
That some of those valuations, some of those stocks are up 70, 80, 90%, and no one's touching them. Yeah. So if you've lost 90% on your stock, you can basically double it for 10% extra, but no one will put the 10% in, right? And then a lot of these companies recover and go, oh, it's been a hard journey. Well, deploying capital at the exact wrong time. So
yeah, absolutely. Okay, so we've got a heap of questions that have come through, and I have a confession. Oh, yes, but we've got questions for Jamie, which we'll start with.
Sure.
But I just want to make a special note. of two questions. Can you just scroll down a second there, Drew? A little bit further to the actual first questions. So I'm just going to...
You broke my heart, that one?
Yeah, there was a question for... By the way, everyone that submits a question this week gets a free Value Investor program. So just write into us, you get a $500 course for free. Why? Because I made a mistake. Because last week I said there's no question, or there's very few questions. But I realised the spreadsheet that we used to collect the questions was broken.
So
because
they had to suffer through us talking for 45 minutes last week.
We have actually received over 1,000 questions in the last 7 months, and the spreadsheet automatically defaulted to 1,000 rows. And then I was like, "There's no more questions." So here he goes. Which one is it going to be? Perfect. I don't know how that kind of works. So there was a question from You Broke My Heart. I sent a question through. That was from Toby Larone. We will get to that in a minute. And the other one was I have 1,000 questions. And that's ironic because we have over 1,000 questions now. But yeah, I've got to make an apology to say you can send your questions in via the link in your podcast player. Select the Australian Investors Podcast.
That's why you don't use Google Docs.
That's why Google Docs is amazing, Jamie.
And long Microsoft short alphabet.
Okay. That's a good question there. Jamie, are we at the bottom in real estate then?
You pose this question to yourself.
I don't know the answer.
My other question was going to be, will property, I think it's not in here, but will property be higher or lower in a year? But that kind of is pretty obvious.
I think you have to separate it though. If you go listed property, I feel like you're nearing a bottom in listed property because the market's valuing it. Yeah. But if you go unlisted property, I'd say you've still, even if it's half the difference to listed, you've still got somewhere to go.
So if you gave me a cash fund and said, I'm going to invest in real estate over the next 18 months in a cash fund, I'll give you all my money. If you say I've got an existing portfolio, I really want to know that you've valued that property, the existing portfolio, fair and reasonably. Yeah. Now, the market is saying there's kind of a 30% discount to NTA with gearing. So it's not that the market's fallen 30%. It's just that the underlying asset has fallen. So it just depends on which investment vehicle you're going to deploy. Yep. I'd be looking at opportunistic property in the next 12, 18 months. Again, it's just what Drew used the words before, blood in street. There's always the best opportunity in blood in street. If you think about who gets affected most, and it's probably not mortgage belt really that gets affected most. It's probably Peninsula property in Melbourne, Peninsula property. If you go down to Sorrento or Blackgowrie.
Second houses.
Probably down there has to be off 30%. Has to be, maybe 35%.
Or not trading.
Right? So there's probably a couple of distressed people that need to sell. They've bought, a $2 million house, interest only at 2%, 40 grand, I can afford that. 6%, I can't afford that. I now need to sell it. I get behind. So I think about where you buy it and what does it look like. But am I more likely to buy property now than I was 2 years ago? Absolutely.
I think you're about to see a big run of independent valuations of all portfolio's too. And if people want to be opportunistic,
end of financial year,
exactly.
Yeah.
So most do like Excel or whatever you call it, desktop, which just means Excel or Google Sheets, I assume. That's how they do a lot of valuations or change a cap rate.
Google Maps, I think it is. Just look from the outside of Google Maps.
But the big one is if you want to raise capital to deploy in this environment, as you said, you need to revalue all your assets to make sure you're raising capital a fair NTA, which I've seen starting to happen. So you could see some revaluations down at the same time more capital comes in to buy cheaper properties. So 30 June is usually a big period for revaluing unlisted assets.
Well, correct me if I'm wrong, but most of these big property funds will do independent vals once a year, and they do their own once a quarter or once every 6 months. Right?
That's about right. Yep.
Yeah. Not saying that they don't do a good job of it, but the independent vals may have to be realistic for once in a long time.
Sure. I mean, there's conflicts in everything, right?
Yeah, there's huge conflicts in that capitalization rate.
So if you're employing me to be your valuer, then
you're going to want to come again, aren't you?
yes, I want to be your value for the next 10 years. So you can see in the last 18 months there's been a bit of a flip in terms of valuation techniques. So historically it would have been on a cap rate, cap rate's low, this is what we value it. Everyone's going, oh, we can't use cap rates anymore, we've got to use something else. So we've got to have comparison sales. It's all about comparison. Nothing's selling, so I can't value the asset down. And then the industry gets squeezed to the point where, because of these liquid property funds, you can argue that you shouldn't try to invest into a liquid property fund. The liquid property funds remain nameless, but they've had big redemptions. So now they have to sell physical assets. Now you're selling physical assets into a market where there's very few buyers. So there's going to be some brave groups that set up opportunistic property funds or buy more property. They're going to do really, really well. I'm sure family offices are keen. Pension funds are keen.
Yeah. They're looking for places, right?
Sure.
Yeah.
Absolutely. So
So we were comfortable holding a bit more cash for clients this quarter as well.
Okay. So questions for Jamie. Maybe I go, you go, Drew. NVIDIA sells something to do with AI, mate. Higher or lower in 12 months?
And I've been higher, he's been lower, so you can just copy me.
I have no idea. Did you say higher?
Yeah. It only has to be a cent higher. So.
Here's the problem with NVIDIA is similar to what I said before. Every time you try to value NVIDIA, they go, you value everything, and it's a present value, and go, it's overvalued. They reinvent themselves like that. No one saw AI, and you won't see the next thing. So NVIDIA is a leader in chip market, and essentially you need chips within your portfolio. So NVIDIA, I would say it's going to be higher.
Okay.
And now a question from Andrew Deremith, which is...
The resident economist.
Will interest rates fall this year?
This is 1 year, so I get an invite back.
This year or within 12 months? Does he get an extra 12 months?
He gets an extra 12 months.
He gets an extra, but there's less meetings next year because of the change in the RBA.
Okay, rates will fall sometime next year. The interesting thing about that is the size of the fall, because if you have a look at the history of rates falling after increasing, it's actually the first move is 75 basis points. So it's actually quite huge.
Something happens.
Something happens, right? So it's kind of build up pressure, pressure release. So it'll be interesting what they do this time.
That's why it's good the rates are so high that there is room to do that.
Yeah,
and we know they will, because every crisis we've had, they've cut rates more and more aggressively and more quickly.
Well, they have to. They get the mortgage belt. They have to get them spending again.
But we talk about the wrong thing, don't we? We talk about higher rates are bad, but Drew and I represent a couple hundred investors that now they can get 5.5% in a term deposit, basically risk-free. I mean, that's fabulous, right?
Yeah.
If you're a saving, well, there's a question about compound investing, compound rates in a minute. But to compound fixed income, you've got to get an interest rate. Yeah. So it's hard to compound at zero.
You've got retiree portfolios. They got a lot of these conservative assets, right? And then this is money for jam. Yeah, right. Okay, so Drew gave me a hypothetical last week, which I'm not very good at. He gave me the sector returns. I think that was the quarterly returns of all the sectors in Australia, like GIC sectors, and then the 12-month returns. And this is where we said that IT was a fantastically performing sector, materials, utilities, communications. And he said, which sector
do you think will perform best over the next 12 months? I said property, and
I said healthcare.
Yeah, with some empirical data that says over the last 35 years, healthcare always outperforms.
Yeah.
It's not
I'm a numbers guy.
It's not a sector. So can I answer off this? Or
sure.
You're going to go small caps?
I'll go smalls.
Yeah.
That's what I said the week before.
That's why I took small caps off the list, because you both say smalls all the time.
So you just deleted it. I think that I'd probably go Drew and say REITs kind of make sense, that they're leveraged.
Given everything we're just talking about.
Yeah. I would say REITs.
Okay. Last question for you.
It's like the dogs at Dow, though, isn't it?
Yeah.
Essentially, you take the worst performing one and...
True or false? Financial planners are proxies for God.
Sure, I'll go with that.
Group operations directors or God, actually?
Take it however you want, obviously. Okay, so questions from the audience. Remember that you can send your question in via the show notes. Instead of picking the favourite question and name, when we do like the funny ones, this week, everyone who gets their question read out gets a Value Investor program. Please write into us. We are snowed in with emails, but that's okay. We're celebrating our 1,000th question, which was a while ago. I don't know when because of the spreadsheet, but it was a little while ago. Just remember that any of the questions that we do answer, we don't know your personal circumstances, even if you dump a huge question on us. We just simply don't know. So it's always important to speak to a financial planner like, say, Drew on my left here or Jamie on my right at Wattle Partners. You will find a link in the show notes for financial planning. You can click that and fill in the form and get in contact with the Wattle Partners team. This first question is very, very long.
You're going to shorten that, right? All I noticed was credit to you.
There's a lot in there. What's the question, Drew?
The summary is right at the bottom here, I think, which is we talked about, I think someone's trying to get their children involved, which we talked about. The
Buy, hold, sell, bribing their own kids.
That was an easy one to answer. But it's something we talked about at the Australian Shareholders Association. I think we did it yesterday on the webinar as well, which is this engaging children, improving financial literacy and passing knowledge to the next generation. So this was talking about, can you bribe your kids to read The Barefoot Investor or other books? Have you got book recommendations in the form of investments? So how do you engage the next generation of children?
We spoke about this at ASA
investors
in Sydney. It's a pretty common topic, particularly for parents that have even adult kids, to be honest, not just younger kids, but adult kids.
We talked about why it was important, but we didn't say
how to do it,
right?
Yeah. So do you guys have any strategies?
I've got one I kind of always go to, which is if you're trying to get the next generation, buy, sell, hold, bribing children. I think we'd all agree it's a buy.
Works. Yeah, it works. Right? Trust me.
Yeah.
To the right level, just make sure it's not all sugar and that sort of thing. There's always a milkshake. There's always a cupcake. There's always something, a cookie. The one thing for me is like, fair. We're not going to get a 14-year-old listening to a podcast, or it's very difficult to find books that are tilted towards them. So if you want to get them
my
involved,
son listens to Owen. That's all.
Does he?
Owen said this. Owen said that.
Does he really?
Yeah.
You never told us that.
Shout out.
Doesn't listen to Drew or Andrew.
No. He knows you.
Get Drew off there. The simple answer for this is find something they can engage with. If you've got a 14-year-old, I'm guessing they're involved in gaming or or something of that nature. And how do you bribe them into reading the book? Barefoot. I've read Barefoot. I think it's a nice entry level. Yep. It doesn't have all the answers, but it makes you engage with your money and get involved with your money. There's a few others. I actually started thinking about it before and I found it's difficult to find which ones I'd read in the past, and engage them with something that is relevant to them. Maybe they're using ChatGPT, so can you find a way to buy some Microsoft with the $500 you're bribing them with? How do you get them interested to go listen to Satya Nadella's presentation? It has to be relatable, and it has to be something they can engage with, at least on YouTube. And
it's such a hard thing, isn't it? Because there are different developmental cycles from 0 to 18. So you've got to know at what point is what appropriate.
Yeah.
Like obviously if they're under 10, they're probably not going to be interested in investing because the concept's a bit
exactly.
So the concept of investing is hard to teach children, but the concept of business is easier. So you think about how that was taught. It was taught at the lemonade stand. Get the lemons off the tree out the back, squeeze them, add them, sugar in. Stand, sell. You got money.
Please put some sugar in.
Garage sale. This is all like Bluey. If you're ever watching Bluey, the Bluey quotes.
I don't watch Bluey, but
Drew's Friday night.
So if you can make your children think commercially, that feeds into this kind of concept of understanding about investment. So what are the two things that I want my children to think about? What career you're going to choose and why? And then secondly, do you have a commercial mindset? Now that might be my mindset. Mindset's all about commercial mindset. And that then leads into, okay, if I understand how a lemon stand works, I pick these lemons off the back and I make X amount of money, then I can apply it to a company, then I can apply it to a compound interest is probably the next thing you learn. So, you need to, as Drew was saying, you need to find something that is really practical, that the child is learning, but they don't realise they're learning.
Yeah, that whole idea of the kinetic learning too, like a lot of kids are better at learning through doing.
Yep.
So that idea is really appealing to me. And I feel like if you have a lemon tree, you've got a competitive advantage at teaching your kids about how to do that. But I think that's really important because I think that's the easier thing for kids to understand is something goes in, something comes out. And if you do that thing, that repeatable process, because it also fosters problem solving. Some kids, however, are ready to learn about money and investing. Like my sister came to me and asked about the Barefoot book. I didn't put that upon her. And so for me, and she was the one who was pushing me to do a Pearler account for kids. She's the one who wants to do that. But what we did is we did a game. She was 12 years old when we did this. Is I printed off, I don't know if I've told you this, Drew, but I printed off, I think it was about 5 or 6 companies, like a little bit of paper, and just put they were almost like cards on the table. And I explained what each company does. It was Nike, there was, I think, Roblox.
Lululemon.
Yeah, maybe not Lululemon for her, but there were those types of businesses. I think Apple was there. These types of businesses, every one of them she could recognise.
Yeah.
And I said, which one of these do you use? I think Wes Farmers was there because I said Bunnings and Officeworks.
Yeah.
Just to do some Australian. And I said to her, okay, now let's play a game. We will put a fake $1,000 into the investment that you choose, and I'll choose one. So we made it a bit of competitiveness. And I said, no matter what happens, at the end of 1 year, you'll get $1,000 in whatever investment you chose. But I said, if you win, you get both. So you basically get $2,000. Sure. But I said, there's one requirement. I said, every 3 months, you just have to tell me what the share price is. And she's in that process right now. So it's like I tried to foster the competitive side. She's not that competitive, but maybe some kids are, while also having the brands that are relevant. So that's how I did it. And it seems to have worked. But she came to me for that. I've got mates that try and do the savings jars, the 3 jars and stuff, which in this case, some of the kids are in single digits, which are probably better.
My kids are already paying for coffee.
Yeah. You know what? That's actually a really good thing
I don't know where it comes from, but it just taps everything.
Oh, like not for you.
Everything.
Like not for you, you mean?
You pay, not for other people. For me, pay some my coffee.
Yeah, well, I think that's perfect, right?
Yeah.
Because that's...
You understand it's coming from somewhere.
Yeah, and that teaches them, like, when you're younger, so like 15, 16-year-olds, they might be getting their L plates. A lot of parents, there's this concept of helicopter parents, but there's this new one of lawnmower parents. Have you guys come across this?
No.
When you make them mow the lawn.
No, not quite. You mow the lawn for them, meaning that you give them like everything. So you're like the helicopter, you're there, you're present. But not only that, you also make it so they can never fail.
Yeah.
And personally, this is very philosophical, but my view is that taking risk and failing is important, particularly in business and investing. So my view here is that like this is probably something to be avoided. And one way you can teach them to overcome some of those fears and take risks is like, okay, you've got to go in when you're a youngster, you've got to go in and pick up the fish and chips, and you've got to hand the money, and you've got to get the money back and make sure it's the correct change.
Sure.
And it's just teaching them to break that barrier.
Yep.
That's my law.
Yeah, I mean, on the same, it all doesn't need to be positive in terms of educating your children. So you can do practical elements that is set up for failure. Pick a stock that you'll get the money what's left. They pick the riskiest, it falls by 80%. So, yeah, totally agree.
So that was from Toby Larone. And then the next one was from Bankrupt Investor. We don't need to read this one out, but it was like, I have 1,000 questions, but I'm trying to buy tickets. Add my tickets to the cart. Can't find the cart. Oh, yeah. So
Blame Google.
Yeah. It isn't my portfolio performance isn't going well either. They say, but there's a lot going on in there, Bankrupt Investor. Yeah. So when you go to Rask Education, you can just click Add Tickets to Cart, and then in the top right-hand corner it says View Cart.
Go to cart.
It's a bit confusing, I admit. It's in a weird green color. Drew, where do you want to jump to?
Do we want to go money hungry, which is a bit of a credit to you on one of your ROIC, how return on invested capital.
Yeah, so
redefine ROIC.
So friend of the show, Luke Larrative, actually corrected me on. Well, he didn't correct me on this. He one-upped me on this. So Money Hungry writes in and says, "Hi, Owen, thanks for writing this wonderful article." And we'll put the link in the show notes. It was about the ASX's best companies ranked by return on invested capital. Return on invested capital, if you don't know what that means, it's basically like the profitability of a company. And you want to have companies with high ROIC maybe, because what it effectively means is the company is returning from its investments that it's making within its business. It's returning a high level. And there was I crunched some numbers on this, and what I found of the top performing companies in Australia, there was a correlation of 0.56, so a positive correlation between high ROIC and stock price performance.
High and increasing, or just high, historically high?
Just high historically. Yep. So meaning that if you have a company that has high internal rates of return, over time it will
tend to do better than those that don't. It's not a perfect explainer because 0.56 isn't very strong.
Yeah.
Yeah. So it was just bundled with about 5 other things. But then Luke, who had access to FactSet, did one up me, and he said the best measure is actually over 5 years, I think he said.
Yep.
So rolling 5-year periods, and it's an even stronger indicator of performance.
That makes sense, right?
Yeah. And so what we're looking for when we look for companies here is basically a strong correlation between businesses of quality. They tend to do better over time.
So this is kind of better than dividends, for example, because if they're making free cash flow, they can reinvest it.
Exactly, because the dividends only capture one element of the
That's
quality.
More relevant to like a Microsoft and some of the biggest companies in the world that are reinvesting.
They would always be at the top of that chart, right? So that's the explainer there. There will be a link in the show notes to that full article. So Lady on a Mission says, hey fellas, I've been learning about compound interest and long-term investing, but also understand you must diversify. How do you do both? So how do you get the compound interest and the long-term investing, but with diversification? If I want to take the most advantage of compound interest, don't I just run the risk of not diversifying? See you in Brizzy. Who wants to answer that one?
I think diversification is key to getting the benefits of compounding. And this is something we talk about.
But you're changing the question there. You're changing the question from compound interest to compounding, right?
Didn't we talk about this?
Just answer whatever you want.
Exactly. Like a politician.
What's the question you
Keep going.
want to answer?
Just ignore that. Sorry, Drew. Cue Drew.
Well, it depends which context you take it from. Compound interest is kind of, you're referring to like compound interest on a term deposit or a savings account, and you're letting it go in and in. I viewed this from the context of compounding returns within a portfolio, which have different answers. But if you think about how do you get the benefit of compounding in a portfolio, it's by investing over the long term. And you put it as simply as possible. How do you make sure you're not worried enough to be selling in and out of market over a period of time? And that's by having a highly diversified portfolio and sources of revenue and income and returns. So I see them as going hand in hand, because we know during periods of volatility, we get phone calls about people wanting to sell down. But if you're able to, hold long duration bonds like you were talking about, that helps you weather that storm, you're less likely to sell and less likely to give up on that compounding.
Yeah, it's kind of like rotating, because this is the challenge, right, Jamie? When people are new to building portfolios, they think everyone that says you need to be concentrated, you need to have conviction, these types of phrases that we use.
Sure.
But then they say diversify. So people are like, well, how do I do those two things?
Yeah, okay, got it. I think the power of compounding is, especially compounding interest or dividends, is that you actively are making investment decisions. So I see people come in all the time and they go, I had an investment portfolio, it's not doing very well. And then they'll have 25% of cash. Well, how did you get cash? Well, we just got to the point that we weren't sure on what to invest in. All the ETFs that were flogged to us last year are down, and that's their biggest issue, right? So they haven't got a long-term strategy. They're not reinvesting their cash. And that's why you see so many wealthy clients that come in here. They've just had and I don't fundamentally believe in it, but it works really well as a dividend reinvestment plan, because they're actively making decisions on their distribution. They're getting the power of compounding because it's automatically happening.
Just staying invested.
Yep.
Yep.
So you basically just agreed with Drew then. No. But to round out this question,
Sure, I think it's.
You think like this is the whole point of building a portfolio, like with Waddle clients, right? Is like you said before, when bonds fall, you rebalance, and then you're prepared for whatever comes next, and then maybe a different asset class rises, and then you can trim, and then you redeploy.
Absolutely.
Active.
The golden rules are basically all built around this concept of how do you stay invested over multiple cycles and periods of volatility, and that's how you get the benefit of compounding.
Speaking of the greatest investment idea of all time, thanks for nothing. And the next question and name is FANG,
Good segue.
like the ticker symbol. Thank you very much. Is FANG KS for nothing? Says, bought some FANG in June after you piqued my interest. Like the
Not
idea,
personal advice.
We did not recommend that. Like the idea of exposure to US technology, why did the dividend tap turn off the moment I got on board? What does LNAs mean? Or LNAS?
LNAS.
I don't know what that's in there for.
Long
that's
NASDAQ.
I added that.
Oh, you that was James' notes.
My notes,
By
my
long
notes.
long
Okay,
NASDAQ.
right. Okay.
Yeah.
So why did the dividend tap turn off the moment they got involved with FANG? No idea, but
I can't answer that.
This is just the nature of the structure of ETFs. So an ETF is just a wrapper or a trust structure which means the income you get from it is a combination of dividends and capital gains.
Oh, are they referring to?
Why did the distribution stop, essentially?
Ah,
Yeah. So
right,
there's
okay.
number
Gotcha,
one, the stocks
gotcha.
you're investing into here, the best yield you might get is from Microsoft, and it's probably 2%.
Yeah.
So you might get a small amount of income coming from there.
Do they pay monthly? Pay.
Usually
Nah.
quarterly.
Yeah.
Yeah, okay.
Yeah.
But it's bang. So, and as most people don't realize that when you're in an ETF, a lot of the distribution or the income you get is actually realized capital gains from throughout the year.
Yeah.
And in this case, the first half of the financial year was incredibly bad for technology. The second half was incredibly good. So if that portfolio was turning over in the first half, it would have realized losses. Even if it was turning over in the second half, it would have realized gains.
No.
Share price might have gone up, but the distributable gains were zero.
So you're saying what is called as a dividend might have been dividend, was just realised capital gain.
Yeah.
Exactly.
Yeah, and I think that's the confusing
That's the short
part.
version of
Everyone,
a long story.
there's the two things that people don't understand with ETFs and probably just managed funds in general is that one is the turnover inside a portfolio, and the second thing is the tax or the distribution that's on the tax as well. The tax that's on the distribution, meaning sometimes it's capital, sometimes it's short-term, long-term, foreign income.
Sure.
Yeah. But I think in summary, FANG is probably not an investment that people make for income. Look past that yield and actually understand what is the income component. The golden rule at Waddle Partners, Jamie. Plus growth equals total return.
Correct.
Yeah.
So this is all about the G.
Yeah. Yeah. All
And
about the G.
one of the things in tech stocks that we think about stocks in general. If Drew and I are having a beer together in 30 years' time, and Owen, you can come along. You're probably still working though. We're retired. And you said, "Oh, that worked. I own that stock. It worked." You can nearly start picking those stocks now. You can go, "Do I think Microsoft's going to be stronger in 30 years' time?" Well, for sure. It's going to be something you want to invest into it. So if you start kind of thinking about it in reverse versus forward, and I find it easier to make strategic decisions and then also stock decisions versus do we think it's going to go up or down?
Yeah. Yeah. Okay. So the next one is a very long question. It comes from Crystal Balls. It says, "Gents, I am investing mainly via my SMSF. To help me sleep at night, rather than attempt to time the market, I am keen to introduce greater diversification into my portfolio. They've added a few fixed income ETFs and I think a few listed vehicles there as well. I'm on the lookout for further uncorrelated assets to add to the mix, and I'm open to suggestions. In my reading, I've come across managed futures as a possibility with potential to provide or even negative correlation to other asset classes, as well as quote-unquote crisis alpha. Performance in 2022, for instance, was stellar. There is an ever-increasing number of ETF options in this space in the US, but not so much here in Oz with managed funds such as PIMCO Trends or AQR among the very few. Are these worthy of consideration, or am I falling for marketing hype and recency bias? Gents, please look into your crystal balls and tell me what the managed futures holds." So this is quite a technical question for people that aren't familiar with managed futures and those types of portfolios. So we might lose a couple of people for a few minutes. That's okay though. And also just important to remember, especially in an SMSF, you get advice, which I think is what one of these guys might say in just a moment. Jamie?
Yeah, so I think a good place to start is what are the building blocks within your portfolio? And you're down in, this is a long way from building blocks. Essentially, you're down into alts, you're into liquid alts, and now you're starting to think about what is the combination of liquid alts that you're going to put together to buy.
This is
PIMCO is a stellar fund, and so is AQR. They're both really good funds.
Super reputation.
Sophisticated, big pools of money, and it as an alternative a hedge in a portfolio. Some years they do incredibly well. So trend following, apart from the last 12 months, has been a horrible place to be for 5 or 6 years.
Since the GFC.
5 or 6 years before, that's right. So the concept of trend following didn't work. It doesn't mean it shouldn't be included in a portfolio, but it's essentially a portfolio hedge. So while everything else was doing well, it was doing poor. Guess what? Everything was doing poor in the last 12 months, and it did well. So the question is probably not just, and I think it's a bigger question for crystal balls to think about. Not what is not what he's holding, but how much of it is holding, right?
Yeah.
That's it, right?
Yeah. They try and slip in a few cheeky ones, so I don't know what this one was trying to say.
Anyway, so both are good ideas. You are trying to diversify your portfolio with alternatives, and you're trying to look for listed solutions. A lot of the solutions that are truly diversifying for portfolios aren't available on the ASX.
Yeah.
And the reason why is because typically illiquid, and to be on the ASX you need to be liquid.
Yeah, there's a lot of rules around that. And SMSF, I will add, before I throw to Drew here, I will add one extra thing. Get advice. Like
That was what mine was going to be. Yeah. It's like
SMSF to go straight down and manage futures.
So you're picking what's available or what you can see, whereas our partnership with Atchison is basically they will run a massive amount of risk and feasible analyses around how these investments would complement with each other and how they'd react in different
attribution models,
environments.
Yeah, factor analysis.
Yeah. And then how much do you put in trends when you've got these other types of alternatives in your portfolio? So there is a lot of
particularly advisors have platforms, right? So in this instance, most retail or direct investors have one platform, the ASX, but advisors have this entire other pool, which includes like wholesale funds, which are out of touch, like from most individual investors. So there's probably, I don't know how many, but like CTAs and managed futures, there would have to be 50, I'd have to say.
50-ish,
Yeah. So like definitely get advice on something like that, because just the portfolio composition is just really important for super. Okay, so
one of the things that we've noticed too is that to actually add to diversification within your portfolio, you actually want products that have really interesting correlations, but that have volatility. Yeah. And what the industry has done is create these products for mum and dad investors, and essentially they've killed the benefit of diversification by diversifying them so much internally. They've given you like 5% and no vol. Well, that's a term deposit.
You have to have vol
buy a term
to get
deposit,
returns.
right?
Yeah.
So then you have to have vol, so something that's going up or down 20 or 30% every year to get the real portfolio benefit of it, but they're not really available to the retail investor, even to the retail advisor. You get these kind of complicated products which are all designed around low vol and some type of return.
Yeah. Okay, so we've got time for two more questions. One here from Deremith. Dara-myth question mark. Hi, general financial advice bros. That's very good to remind us. And people's champion, Dr. Andrew Deremith, Esquire. I have a question for the Dr. Esquire. If instead of becoming an economist extraordinaire in your younger days, you became a, quote, heavy blue-collar worker, end quote, e.g.
Have you seen these hands?
No calluses, e.g. Tyler, Brickie, etc., would you maybe look at investing in high growth in super and more income/growth outside of super, so you can substitute your work days when you're older, as working 5 days a week at 60 might be a bit much on the knees? You guys are rad. Keep up the good fight.
Rad.
Love it. I haven't heard that for a while.
That's a great question, though.
It is a good question.
And it's a big part of what,
Yeah, no, you go.
what a good financial advisor should do, which is work out what are your objectives?
Yeah.
Do you want to retire early? How do you want to retire? And where are the best homes for the various assets or sources of income you're going to produce? It doesn't have to be shares and bonds. It could be property as well. Yep. So essentially what you're saying is your longer term growth, potentially higher taxed assets, you're putting into a lower tax environment. Yep. And you want to generate a passive income from a portion of your portfolio. So naturally, if you can't access your super until you're 65 or 60, you want some assets separate to that. There will always be other considerations, like the ability to stream that income, or if you've got a high taxable income, you don't want all that income in your own name. But it's good advice should balance each of those objectives as much as they can.
Yeah, Jamie?
I think that people are generally too conservative with their superannuation, given most have a 30-year time horizon. Yeah. So then, kind of load up on your risk assets in superannuation and let time do its thing. You need to think about how you get out of them. But also now, when you retire at 60, life expectancy is so long, you've got another 30 years as well, right? So you're essentially a 60-year long-term investor.
Yeah. We had actuary on the show not too long ago who actually talked about it. Just in super a lot. A lot of people probably just aren't taking the risk because we're taught not to. But yeah, that's a great question because a lot of people, blue collar, your body, your physical body is kind of falling away, and you can't rely on that physical capital anymore. So you have to use your intellectual or your financial capital to keep growing your wealth, and transitioning for that is really important. Okay, Drew, I feel like you should pick the last question.
I should. I mean, we had an interview with GQG, so a big global equity manager this morning. So I thought maybe this one from Watch and Sachin. I think that's a reference to Sachin Tendulkar, maybe. I'm not sure.
Okay,
relating to India. And I'll pose this one to Jamie, which is, what's the best way to get exposure to India, NDIA or INDA, which I think is the beta shares and the Global X ETFs, or something broader like an Asia EM markets ETF or fund? And what would this look like in a core versus satellite approach? So maybe it's a good reflection on building global equity.
Yeah. Sure. Yeah. So it's a good question. I think that in markets like India, you need to think about being active versus passive. I think you would first start around the building blocks of your global equity. So as a rule of thumb, Drew and I think about building portfolios and how you would outperform the MSCI over a longer period of time. And our tilts typically, historically, it's been tech, less tech now because it's inbuilt into indices. But essentially, it's a market weighting and then a region weighting. And our region as a firm happens to be Asia over the US or Europe, and it's actually over EM. So we don't think you get that much extra by doing EM over Asia. Yep. And then it's a combination of finding an active fund manager that's giving you something substantially different than the index. Yep. Who is that? At the moment, we use a couple of managers.
Here's a question. Do you look for, when you look at the portfolios of these fundies, are you looking for fundies that have 40 to 60 stocks? Are you looking for more concentration than that? Is there a rule that you have around that?
Yeah, I would be not, it wouldn't be a concentrated play.
Yep.
And it would be the fund manager would have real local knowledge. Having a bias, I have biases, unfortunately, but I think Asia, and I think typically I prefer, not always just select, but I would prefer female Asian managers that are specifically have got specific knowledge around Asia. Yep. Asia's a really complicated place, right? It's not like US or Europe. It's kind of 9 different regions, different cultures, different views. Yep. As a group, we know that the demographics is phenomenal for growth over the next 30 years, and India is a play of that. Who would we recommend in that? There's a couple of groups, and they're typically funds, not ETFs, Drew. Yeah, so you can't get them on an ETF. So I would start. I think you have to start with an overweighting to Asia as to start with, and then think about where India fits. Again, it's in portfolio construction, probably people managing $3 billion is thinking about how do they get specific India exposure. One of the things I've seen is the explosion of ETFs. And you can buy everything, but I think probably 60 or 70% of what you can buy in ETFs, in my view, aren't suitable to a lot of long-term DIY investors. The risk is so specific. And if you are using some of these ETFs, you probably need 80. And we're yet to see a properly constructed ETF portfolio come from a client and go, hey, we're doing this. What do you think? Yeah. And it being properly constructed. So, Drew, do you have further comments?
No, I agree completely.
Yeah.
I thought it was a beautiful question.
Wow.
I thought it's a great question because it is an incredibly complicated part of the market. Yeah. And it is an area where you can benefit from active management, but it is an area you can go wrong completely as well.
Yeah, there's the FEMX ETF, the Fidelity Emerging Markets Fund. It's got about 500 mil under management unlisted.
Fidelity.
Fidelity.
What did I say?
Fidelity.
Yeah. And what is it?
Fidelity.
Yeah.
Okay, I better get that right before I go on.
I mean, they're excellent Asian managers, right?
Yeah.
So,
yeah.
And your man's really good, and there's a group of them. But
It's where that like the pure fundamental research businesses, like where they all say that, but the firms that actually back that up with proper research.
On ground, understand it, you know.
Yeah. And it's interesting that portfolio that I'm referencing actually has a co-portfolio thing, which I don't really like to see all the time, to be honest, co-portfolio managers, but different experience, different parts of the world as well.
If you were in, you mentioned GQG, right? So their main fund, it looks to the whole world and sees they can invest in anywhere. So you will see if there is an absolute opportunity in India, then the big diversified funds will go overweight India.
Yeah.
So, you know, it depends how you're building your portfolio. If you've got sector specific, it's your call. If you're diversifying to really large managers, well, just any manager that can choose any region, they're going to make your sector bets for you. You're not going to make the sector bets.
Yeah. Yeah. Fair enough. So you can get in contact with Jamie or Drew or the team at Wattle Partners. They'll be actually in New Zealand around about the same time we'll be in Perth for the roadshow. So we're going to miss these two gents there, but we will see Drew in Adelaide. If you haven't got your tickets for, by the time this comes out, this week's Adelaide show, there are about 5 left, so I probably shouldn't say that, but there is a couple left. So
0 left now.
Yeah, there's probably none left. But Renato and Fatuma will be appearing from Wattle Partners in Perth, so you'll be able to ask your questions live to the financial planners in the room. Heaps of experience between those two.
They're great advisors.
Yeah, so come along and say good day. You'll find a link in the show notes to get in touch with Wattle Partners. I would say that there was a winner for this week's best question and name, but they've all got it, so I'll just read them out, the people that made the shortlist. The Bankrupt Investor, J. Fly, Watchin Sachin, April, Going to Morgan's Housel for a Buffett with Warren, Sucker for the NASDAQ and the Title, Financially Savvy Barbie, great show, Franking Stein's Money, Deremith, Crystal Balls, Thanks for Nothing, Lady on a Mission, Money Hungry, Bankrupt Investor, and Toby Larone. Send us an email. Yeah,
I just got that.
Yeah. That's all right, man. That was at the start of the show. No, go for it. So one thing that we've got to do, the final piece, the send-off into the distance from Andrew Deremith.
We're going to get a push back
Drew
on
Meredith.
these dad jokes too.
Yeah, okay. They're good. The worse they are, the better they are.
Exactly.
So here's something from Dad Says Jokes.
I told my son to go find out what nada means in English, but he came back with nothing.
Well, that's great, mate. Thank you for sharing that. You can rate Drew's quality of that joke. Just let us know. Send an email directly to Drew.
It's a 3.
Well, gents, that's been heaps of fun. Jamie, mate, I hope we see more of you on the show.
Sure, no problem.
Loved
Thanks
it.
for
So
having me.
thanks for taking some time out of your busy schedule. And
No
Drew,
problem.
as always, thanks, mate.
Good to see you.